Transaction costs concept by quantum simulations. The company is a form of organization responding to motivation, production. The theory of transaction costs allows us to understand what a company represents. Each time there is an exchange between two economic agents, they carry out a transaction. The contractual specification, explicit or implicit, of the date and place of the exchange, therefore, has a cost, the transaction cost. Creating a firm, by internalizing part of the exchanges, eliminates part of the transaction costs. For example, hiring an accountant avoids consulting one each time an operation has to be carried out. The definition of transaction costs is based on the assumption that contracts are incomplete. After that, it may be necessary to renegotiate the terms of the contract if everything has not been foreseen. Thus, in some cases, the market will not allow agreement at the lowest cost. Numerous negotiations may be necessary and increase costs a little more. The conceptualization of the firm as a fabric of contracts then takes on its full meaning. The company, from small to large, from local to international, is, in fact, a set of contracts with its accounting firms and law firms, intellectual property management, relations with subcontractors, relations with suppliers, relations with clients, etc. The value of the company is based on this thoughtful balance in which all these dimensions are optimized. Therefore, the company will retain the organizational form that will minimize the sum of these costs. Transaction costs, therefore, condition the choice of a growth strategy. The company must correctly identify the determinants of transaction costs insofar as they can evolve and make the initial choice ineffective. Applied to industrial organization, economics simplifies the firm by proposing a representation based on the production function with two inputs, capital and labor. It is therefore assumed either that the other parameters internal to the firm, for example, human resource management, product marketing, etc., are kept constant, or that the macroeconomic environment, competitive forces, etc., are kept constant. The production function for a firm is Q equals FK, L. The firm is positioned in a market. The demand function for its products is exogenous. The firm knows the selling price and the purchase price of inputs, i.e., the price of raw materials and the wage rate of employees. To achieve its profit maximization objective, it has a multitude of possible combinations of its inputs. Knowing the selling price and the demand, the company can infer the quantity demanded and, therefore, the quantity it must offer itself to maximize its profit. To offer a certain quantity of outputs, only certain combinations of inputs can achieve maximum efficiency. The company will choose to meet the demand while minimizing its costs. This search for the lowest possible cost will determine the optimal input quantities. Concretely, knowing the sales, the company will place a certain number of orders with its suppliers. All production processes involve the use of two types of assets, fixed and variable investments. The first represents those that are made once and for all over a certain period, the second are those that are directly related to the quantities of output produced. The cost function is CT equals CF plus CV. When a company grows in size, the initial decrease in average cost is due to a more significant division of labor and many technological factors. However, too much size increases organizational and administrative costs.